So I was just looking at the S&P, and basically you can see, it shot up. This would be the dot-com bubble. So it's around about 2000. Then it crashed down to about 800. Then, up popped the central banks, they slashed the interest rates and all that kind of stuff, and began the housing bubble, which basically reached the same level around about 2007-8, then crashed down to about 800, slightly lower, but basically similar. Of interest would be, I was thinking, like, is this, I think it went higher. Yeah, it went higher than it had during the dot-com, like marginally, but it did just go over. And it did fall slightly lower, but, basically the same. So then we had, again, interest rates slashed to essentially zero, and up popped the markets, and now we've just hit slightly higher than the previous high. So the question is, do you reckon it's gonna fall to lower than the last time? Do you reckon it'll fall back down to 800? This other chart below is known as the RSI. That's kind of a measure of how bullish the markets are. So it just looks at the price, and it is a formula, and you can work out what the value of the RSI is, and so you can kind of see, okay, the market's very bullish. The key levels are actually 70. 70 or above is very bullish, so that might be a good time to get out, because the market's gotten inflated. Though when it's trending, it can remain above 70 for a long time, so it's not that easy. And 40 or below is kind of oversold. So typically, here when the markets fell, you'd expect that to be oversold, and that is when, so you'd be looking at that and kind of going, okay, it's down to about 30 or below. You'd have lots of people entering the market then kind of going, I've been waiting for the markets to be down to an RSI of 30, and likewise you would have done well if you'd waited here. And likewise, if the RSI is up near 80, you'd want to be thinking about maybe selling. Oddly here, the RSI was extreme 1996, which I don't that much remember. I mean, compared to, as in, even though the market shot up here, they were not overbought. The market never got crazy, even though the prices shot up. But the reason I wanted to say a little bit about this is that one of the things that people look at is, so here you have the price action, and you can see it's going to up here, and then it fell down here, and then up here, and what you want to look at is, do you get a higher high? So is there an upward trend? So here it did just touch over. I'd say that doesn't really count. These two seem to be nearly range bound. The levels are pretty much the same. But what people look at is these technical indicators, and you look to see, do the indicators mirror the price action? So what you can get is that the prices are heading higher but the indicators are not, and that's known as a divergence. So negative divergence would be like this, and that's kind of a signal that things are toppy, the underlying things are not good. So here you had a high RSI here, which was like 85, 80, near 90 extremes, but then since it fell, so even when it was going up and up here, the indicator was kind of was less and less bullish, or less and less bear. Yes, less and less bullish. So it was more negative. It was not, the underlying indicator was not, and this is a very frequently used indicator. I mean, there are others as well. Now, then when this trend happened, the RSI was actually following it. It was getting more bullish, but it did not reach the same levels that it had previously, while the price actually reached the same and slightly above. Here it fell slightly more, but I'd say basically the same, but the indicator fell even more. So the technical indicator is getting lower highs and lower lows. So the indicator seems to be in a downtrend, which is a bearish signal. So all I wanted to say was, what do you reckon? I'm tempted. I am actually going short the market at these levels because of the reason I just said. There seems to be a negative divergence there, and the risk reward is fantastic. So I'll just have a pretty tight stop loss. So if it keeps going up, I'll be knocked out, but I'll maybe lose, if it's 1637 now, so I'll be out by 1660 or definitely by 1700. So say I do it at 1700, then if it does fall back here, I win. I basically get 8 to 1 odds on something which something that I reckon there's a better than 8 to 1 likelihood of happening. In fact, I have no reason to, I would suspect it's more likely to happen than not.